The U.S. Treasury gold reserves currently account to a mere 2% of total outstanding government debt, one of the lowest levels in history. Why is this critical? And why should you be paying attention to it? We're about to find out. We have Tavi Costa back of Crescat Capital. He joins us now. Tavi, always good to be with you. Welcome back to the Daniela Cambone Show.
Thanks for having me, Daniela. It's always a pleasure speaking with you as well.
I know you posted this chart about the U.S. Treasury gold reserves accounting for, only 2% of total outstanding government debt. A few people in our industry picked up on that tweet, and I thought, explain to us why we should be paying attention to this. Why is it so critical?
Well, first of all, back in the days when gold actually was significantly more relevant, I think back in World War II, a little before that, gold was equivalent to about 40% of U.S. debt. Today, the world keeps saying that the reason why U.S. is able to have only 2% of gold relative to debt is because of its military strength. I like to look at history, and I don't think that's really correct. I mean, sure, there's some reasons for it, but it doesn't fully explain the situation. Today, the US dollar is at one of its most expensive levels, despite the fact that it had one of its worst year-to-date performances since the 1970s. And in my view, we can see very clearly that we're going to have to substantially increase amount of treasury holdings of gold at some point, either through a revaluation of gold itself or through an acquisition of the metal. And so back in the 1970s, for instance, I think our number was somewhere close to 17%. So you can kind of
Wow.
think about these things. I mean, if we're going to be revaluing gold, if we're going to get into those types of policies at some point, of which I'm a firm believer we will be at some point seeing along those lines. If you start playing with the math, let's just say we go back to 17% of the debt. We're back to $24,000 in gold prices. Now, I'm not here to say we're going to go to $24,000, and I don't need to be quoted on that. But my point is how undervalued gold is today, despite the fact that we saw this large increase in prices over the last few years. So it's very bullish long term. I think it wouldn't shock me at all getting to those crazy numbers, given the imbalances we have globally. So to me, it's just green light to invest in the space right now.
Tabby, let me ask you, is there a deliberate policy you think then at keeping it at 2%?
Look, I think it's a response of policies over the last few decades. We've run sort of a very indisciplinary type of government administrations over the last, since the 1970s, perhaps since the break of the gold standard. We've been taking more and more debt. It's funny because a lot of the gold industry has done a lot of work on how much gold we have, and usually it's done relative to monetary base. Usually it's done relative to GDP, or
Right.
usually it's done relative to money supply. But the problem is most of those metrics, like, monetary base is only less than $5 trillion, which is not reflective of where all the debt is. Or money supply is today making new highs and still at $22 trillion. Now, the debt itself is hitting almost $37 trillion, nearly $40 trillion here. So the government debt is much more reflective of how much money is in the system. So this is why I wanted to go back and see where we are. I firmly believe that in order to see the sovereign wealth fund put in place, or buying back treasuries as the Fed is, or the government is ultimately going to have to be suppressing interest rates at some point, because we cannot live in a world where we're paying 4 to 5% of interest payments to GDP. And so in order to see all these things come to fruition, most likely the revaluation of gold is going to be part of that environment. So that's just I think one step towards seeing higher metal prices.
So before I ask you a little bit more about the revaluation, what that means, what do you think is going to force the U.S.'s hand to increase its gold reserves?
Well, I think what's already forcing the U.S. to look very differently is what's been happening outside of the U.S. is Does the U.S. even have the largest reserve of gold in the world today? I don't think anybody knows that answer. We can argue and say that maybe China already surpassed the U.S., but certainly has, let's just agree that it struck some nerves in the administration that other countries are accumulating the metal, and we've chosen to be on the side of this accumulation or buying spree of gold for the last decades. And so I do think that this is very problematic. I believe that we're now holding one of the lowest reserves in 90 years. We're going to have to change that at some point. And so it's very likely that the U.S. is going to participate on this, and pay attention to all these, in my view, all these differences in shifts of the way the government's engaging with even the private markets, like this MP
Yep.
Materials investment of the Department of Defense, a
Yep.
15% stake on this. Last time we've seen something like this was in the World War II. And so of this degree, some people will say, well, what about those This is not a bailout. This is actually a strategic investment. They're not going to be passive investors. They're going to be active investors taking 50% of profits on their further developments they're going to have in this company. So you have to start thinking, all right, well, what are other critical industries here? Gold has been put into a critical metal recently by the Trump administration. Can we see these types of investments even in the gold space? I think that's I'm very open-minded to this, and not that I agree with it. I actually think this is sort of the government just owning, creating. This is not revolutionary. We've seen this in Africa, in South America, in China, where companies become state-owned businesses. And so, but I also think that as a market participant, I'm just here to see what are the possibilities in terms of policies, and that's. In my view, that's another one that could potentially be the case here.
You mentioned the U.S. debt. In your view, is there even a slightest risk of default?
Oh, there's always the risk of default, and it's not small, but we have to think with, again, what are the paths, and I think there's two. If we're really going to break it down, of course there's more, but two, they're most important: default, or the second one is inflating your way out. Inflating your way out, it's also painful, but it's way less painful than defaulting. And so throughout history, we've seen both played out. And usually the one that takes course more often is inflating your way out of a debt problem. So I really believe that, look at the change, the big, beautiful bill of which, really emphasizes construction, infrastructure spending by most of the companies here in the U.S. And even the government itself is likely to be taking some of that participation too. And so as we see those things occurring, I really believe it's only going to drive inflation higher. And on top of this, we're probably going to see the fiscal dominance, which just means, having control over interest rates, just like we saw in the 1940s, and eventually driving rates a lot lower with a new Fed chair, or buying back treasuries. I mean, or creating a trade agreement where you see Japan buying U.S. treasuries in exchange for something else. All these things are on the table right now, and so as we see those things happening, the dollar is likely to devalue substantially, in my view. This is a multi-year decline.
I agree as well. I mean, I just had a conversation with someone who was uber bullish the dollar, but my devil's advocate in me was saying, but all signs are pointing that they want the lower dollar, Tavi.
If I was interviewing somebody in that front using your side of the table here, the first question I would ask somebody who's long the dollar is, how can you have that view when looking across every major country in the world today? We're paying between 4 to 5% of interest payment to GDP, when no other economy is paying anywhere close to this. Believe it or not, Canada paying less than 2%, Japan paying less than 1%. So if you
Yeah.
think that imbalance will close, and ultimately, because we can't sustain having to grow the economy at 4 to 5%. Look, just today, if we take rates to zero, we're not paying any interest payments, our deficits are still 4% of GDP. That's a very significant deficit. It's not that the U.S. has a exceptionalism or anything, that most tend to say is we're just spending more than other economies. And what allows us to do that is having a reserve currency status too. So I think more and more those things are going to be questioned. And ultimately, I believe either the Fed or the Treasury are going to have to be responsible for reducing the interest burden on the debt. And as we see that occurring, that's going to have an impact on the dollar, very substantial impact on the dollar, because interest rate differentials are going to be contracting in a large way. In other words, the U.S. rates are going to have to fall much faster than other economies.
Yep.
And as we see that occurring, I think the FX is going to reflect those changes as well.
Very valid point, Tavi. Excellent question. I just want to go back to your point about revaluing gold, because I know this is a topic that's tossed around in our circle here. But what does that really look like, right? And what are the steps that would be needed in order for that to happen?
Well, we're seeing already some changes in the Treasury that is basically allowing them to do those big price shifts. But I would say that the biggest one in terms of the buying back of Treasuries, for instance, how do you do that? Well, you have to have a large TGA account or cash in hands of the Treasury to be able to purchase those. Now, some people would say the Treasury has unlimited cash, and it does, but it has to create some sort of policy in order to allow or unlock those that cash to do so. And one way you could do is increasing the collateral of its balance sheet, or in other words, increasing the value of its balance sheet that then hence increases its collateral as well, that then allows the government to have more cash. And so you have to look at how much gold we have, about 2% of the debt or so. If we increase, and it's in the government's best interest to have a higher gold price right now. The higher gold prices go, the higher the balance sheet of the government is, and also most likely the higher the collateral, and most likely higher how much cash they can take. And so they can then buy back treasuries or buy more gold, whatever they decide to do with that extra cash that they will have. And so that's sort of the mechanism that I envision that will probably take place.
Just another point here about China. I moderated an excellent panel at Rick Rule's show. And one of the questions I asked was, okay, we know how much central bank buying was driving gold price. Do you see China especially slowing down its gold purchases? And what impact would that have on gold prices?
I don't think we're going to see globally. China specifically could hit a wall or something along those lines. I personally think China, the negative view on China, it was supposed to be the case 5 years ago or
Yeah.
7 years ago, and the worst of China's situation has unleashed already, in my view, and probably is closer to the end than the beginning than a lot of people think. I mean, it's just because the media has been reporting these things, and people think it's happening now rather than 5, 7 years ago. But usually, the media is late to the game, and these things have already developed in a large way. In my view, I think that globally, we rarely own gold. I think I've put out a report that shows basically that globally, balance sheets of central banks own less than 20% of the total assets, and we used to own about 75% back at its peak, which was I believe was in the beginning of the 80s, right after the 70s era. And so let's just say we go back to double that amount, 40% or so. I do think that upward trajectory is a long-term one. And given the imbalances we have globally, that's the way I think a gold investor should think about, rather than think about a single country. Globally, we all need gold. And so I don't think this trend is going to change anytime soon. Now, what we have to also consider is that the U.S. Imbalances on the fiscal and the trade balance side are are enormous when you talk about historically. And so the only way out of this issue really is devaluing the dollar versus other fiat currencies. So the decline of the dollar itself, along with the purchases of gold, could also unleash other trends like emerging markets, like other developed economies. And so I'm very open-minded to those ideas because I do think we're sort of either seeing that in front of us or on the brink of some of these markets beginning to really outperform.
Wow. Complete domino effect, Tavi. Um, just bringing it home for us, what would you really want, investors and viewers to be paying attention to right now? Like something that's top of mind for you on your radar?
I think top of mind for me is what's happening with artificial intelligence. I think that there has been a lot of ways to report these potential changes in society and all that, and we've been using analogs like railroads or the internet. But in my view, I don't think we have ever seen not only a technological shift that is so important for productivity and other things, but really what's really important here is that different than the internet and different than railroads, what we're seeing is an arms race to see who gets there first. And it's almost like an existential threat for the US to not develop enough in terms of infrastructure to get there. And the US is ahead of the technology, way behind when it comes to infrastructure relative to China. So we're probably going to see an infrastructure boom in the US, hence why you're seeing the big, beautiful bill kind of giving you a green light to, paddle to the metal here in terms of spending. And you're seeing the largest balance sheets in the world, the mega cap companies, being able to basically leverage that balance sheet on spending. So there's going to be a world here, in my view, where you have spenders, the
Yeah.
mega cap companies, and earners. And their earners are going to be raw material companies, infrastructure companies. You're going to have engineering businesses, cement, steel. All those things are going to be the earners of this world. And so I'm really excited about that because any recession, any downturn is going to be met with stimulus because we can't stop, right? I mean, if you listen to the Trump administration, they're freaking out about this. I mean, we cannot lose it to any other economy. Right now, China is probably our biggest competitor, but who knows what it could be in 3 to 5 years from now. So this is almost like the nuclear bomb kind of a race to see who gets there first. And so I do believe this is going to really unlock a lot of construction spending, which is currently at around 7% of GDP. And I can see this tripling from here or quadrupling from here very easily.
Excellent perspectives as always, Tavi Costa of Crescat Capital. Thank you so much for joining us.
Thanks for having me.
Yeah.
Appreciate the interview.
Yeah, come back soon. And thank you for watching. We'll have more great content coming your way here on the Daniela Cambone Show on ITM Trading. We'll see you soon.